Hello students, Namaste. In this video, let us understand the concept of microfinance. As we all know, microfinance now is emerged as the important and successful strategy to attain financial inclusion and also empowerment of the poor, particularly women empowerment. In this video, let us understand the concept, evolution, and various models of microfinance. Microfinance is the provision of financial services including loans, savings, insurance, money transfer to the poor who are deprived of standard banking services. The microfinance is the cluster of banking services relatively of lower monetary amounts designed specifically to meet the banking requirements of the low-income people. According to J. Ledgerwood, microfinance evolved as an economic developmental approach intended to benefit low-income women and men. According to NABARD, microfinance is provision of thrift, credit, and other financial services and products of very small amounts to the poor in rural, semi-urban, and urban, provided to customers to meet their financial needs with only qualification that transactions value is very small and customers are very poor. So microfinance is nothing but provision of banking services to the poor and transaction value is very small. According to Reserve Bank of India, microfinance is a development tool whose objective is to assist the poor to work their way out of poverty. It covers a range of services which include, in addition to the provision of credit, many other services such as savings, insurance, money transfers, counseling, etc. Thus, microfinance is not just provision of small credit, it also includes services of savings, insurance, money transfer, counseling, or all banking services extended to the poor who are deprived of formal banking services. So, microfinance is a category of financial services targeting individuals and small business who lack access to conventional banking and related services. The motive behind microfinance is to give poor people a privilege to become self-sufficient by offering them crucial banking services at a considerable smaller monetary amount. The term microfinance refers to extending the whole range of financial services from saving to microcredit to microinsurance to micro enterprises and a lot more for the poorest section of the society. Thus, microfinance is the provision of financial services to the poor who are otherwise considered unbankable. Let us understand evolution of microfinance. The history of microfinancing can be traced back as far as the middle of the 18th century when the theorist Lysander Spooner was writing about the benefits of small credit to entrepreneurs and farmers as a way of getting the people out of poverty. Independently, Spooner, Frederick William Raffeson founded the first cooperative lending banks to support farmers in rural Germany. Microfinance as we know it today has been popularized by Muhammad Yunus, winner of the Nobel Peace Prize in 2006. Dr. Yunus, referred to as the banker of the poor, has been the founder of the first microcredit institution, the Grameen Bank, in 1976 in Bangladesh. He reached the poorest of the poor and provided them microfinance to uplift them. Initially, he was trying to free 42 people from the clutches of money lenders by giving them money owed to the money lenders in order to repay them and become free from exploitation. The main idea behind microfinance is that poor people who cannot provide any collateral should have access to some sort of financial services when nothing was done on the front to fight poverty. Dr. Muhammad Yunus thought of social business. When the existing financial institution failed to help the poor due to one reason or the other, like the quantum of loan required were meager, there was no security available with the poor. So the idea to alleviate the poverty came to his mind. Microfinance began with microcredit, the provision of small loans to very poor families to help them engage in productive and self-sustaining activities. Since the successful initiation of formalized microcredit in 1980s, a number of other complementary services have emerged around the globe, including microsaving, microinsurance, etc. In India, the National Bank for Agriculture and Rural Development, NABARD, took this idea and started the concept of microfinance in India. Under this mechanism, there exists a link between self-help group, NGO, and banks. Self-help groups are formed and nurtured by NGOs, and only after accomplishing a certain level of maturity in terms of their internal thrift and credit operations, they are entitled to seek credit from the banks. These self-help groups are mainly formed and managed by women, and this has become an instrument which has led to women's empowerment and social change. The concept of self-help group is the most important discovery in the context of microfinance, and this is evolved in India. The Indian microfinance scene is dominated by SHGs and their linkage with banks. Owing to the importance of microfinance and self-help groups in the eradication of poverty and in the empowerment of women. There are different models of microfinance. Let us see few microfinance models in India. Number one is very popular model, that is self-help group bank linkage program, where individuals or group borrowers are financed directly by bank without the intervention facilitation of any non-government organization. So bank directly lending money to the self-help group. So SHG Bank Linkage Program is the homegrown model of microfinance in India, which was conceptualized and initiated by NABARD in 1996. 12 to 15 people form the group, start an account with a bank. They start to build up internal funds through thrift and savings. This model involves SHGs financed directly by the bank, like commercial banks, public sector and private sector, regional rural banks and cooperative banks. Model 2 is Microfinance Institutions Bank Linkage Program, popularly called MLP. Microfinance institutions act as an important link for extending financial services to this sector in the country by raising resources from the banks and other financial institutions. So microfinance institutions uh, receive or borrow money from the bank or other agencies, and in turn lend money to self-help groups or joint liability groups. Model 3. Financing takes place through NGOs and microfinance institutions as facilitators and financing agencies. Number 4. Grameen Bank model, similar to the model followed in Bangladesh. In India, The most popular model of microfinance is Model 2, that is microfinance institutions acting as a link between banks and self-help groups. So, microfinance constitutes three-fourths of total microfinancing, where activity or joint liability or self-help groups are formed and nurtured by facilitating agency or NGO and are linked directly with the bank for the purpose of receiving credit. In this video, we have understood the concept of microfinance, evolution of microfinance, and models of microfinance in India. Thank you for watching the video.